Thank you very much, Sam, and welcome all of you. Some of you did listen in to the last session when we did IRA basics and the plan types. So now that I've lulled you into a nice sense of security about knowing IRAs, I'm going to hit you with the hard stuff today. These are the issues that I get lots of questions on. And for those of you that have never listened in, I've been involved in IRAs for over 25 years and actually have been on the road for 19 years doing live training in about 20 states. IRAs are probably 80% of what I train, and the material in this section is really the part that I love the most because it seems like it generates the most questions. Now, when I'm out there training, one of the complaints I hear about webinars is, oh, they're just not interactive enough. People keep interrupting us. So go ahead and put out a big sign on the door where you're sitting now and just say, do not disturb for 2 hours. And then to make it interactive, feel free to chat those questions in because, as I said, I'll get, Sam said, I'll get to as many of them as I can, and if not, you'll get the answers later on. So what we'll cover in today's short 2 hours, there have been several changes to IRAs in the last couple of months as far as cost of living updates, and then also the Fiscal Cliff Act, otherwise known as the American Taxpayer Relief Act of 2013, that was signed into law on January 2nd. So we will cover those through this legislative update. Then we'll go to rollovers and transfers. Qualified plan rollovers coming into a traditional or Roth IRA, and then IRA, moving money from IRA to IRA, from one institution to another. What's the difference between a rollover and a transfer? People use this terminology interchangeably all the time, and we can't go by what people call it. We have to look at the actual action that is happening, because the most important part of this is the sending institution's distribution reporting has to match the receiving institution's contribution reporting, so the taxability of the movement cancels out. And when one institution codes the distribution one way and the receiving institution codes the contribution a different way, they don't cancel out. And customers are getting huge tax bills for $125,000 in taxes owed just because they moved their IRA from Bank A to Bank B. $250,000, $360,000 in taxes owed. They don't owe any taxes on it. One of the banks didn't do it right, the sending bank or the receiving bank. So it's a big communication issue. And then also what I've said in my last 3 or 4 years is I've stolen the most famous line from the Jerry Maguire movie, which is, show me the money. And I've changed it to qualify the money. When you get money in from anywhere, qualify the money. Where did it come from? What plan type? Does the customer have access? I'm even becoming more and more of a big advocate that maybe you should get a copy of the statement where the money was last. So that, because you're asking your customers all these questions and they don't even know what you're asking them, so they're not answering you correctly. And we're so intimidated about asking them questions because we think we're getting in their stuff. And the fact of the matter is we really have to know this stuff so we can get these. I'm probably answering and correcting more transfers and rollovers now than I am getting questions on distributions to beneficiaries, which has always been the high volume question. So we'll cover that. And actually, you should have had 2 downloads. One of them is copies of the slides, but the other one should be 2 pages of quick reference charts for the transfer rollover comparison chart and also for the beneficiary options. So those 2 pages on that separate handout should be a separate download because sometimes when we put multiple per page, you don't get to see those. So if you haven't downloaded those, you can after the training because I do have them included in the slides. When we get into the distributions, we're going to just make a quick point about IRS withholding to make sure that you are doing that correctly and using the right balance before or after the bank penalty to calculate your federal withholding on. We'll look at the exceptions to taking distributions prior to 59.5 and not getting the IRS 10% penalty. And most importantly, again, how do we code that? We'll overview distributions at 70.5. Even though most of your systems calculate distributions at 70.5, sometimes we might have to manually calculate a distribution. And what I mean by that, and let me say it up front, is one of the things that I think that a lot of us are dropping the ball is whenever a customer is over 70 and a half and bringing money into your bank as a transfer or a rollover, you are supposed to ask them if their required minimum distribution that year has already been met from the other institution or if they want to take it from your institution. You have to ask them that question to make sure it's met by December 31st of that year. And what's happening is we're taking this money in and we're not asking them if they took their distribution at another institution. Meanwhile, we don't have their balance on our prior year-end balance on our system, so a lot of these distributions are slipping through the cracks, and the next thing you know, the customer doesn't take it, and then they get a 50% penalty on it. So that's one of our responsibilities at the banks to ask them if they're over 70 and a half when they're bringing money in to find out has it been taken, and if it hasn't, they either have to supply you with the amount that needs to be taken by year-end, or at the very least, the prior year-end balance, so you can give it to them. So you can calculate and then give it to them by year-end. We'll also talk about death payments to beneficiaries. I am now up to 7 red flags that we need to look for when somebody dies and the beneficiaries are taking money out. And this is one of those things in live training that I made assumptions that you were all doing things that apparently you're not, because beneficiaries are getting in a lot of trouble because they don't know the difference on the options and the tax consequences. So we'll go over those 7 red flags also. I could probably come up with about 15 red flags. But right now in the presentation we'll talk about the 7 most important red flags. So these are the things we'll talk about. We will take a break halfway through, about 5-minute break so you can stretch and type in your questions. I'll try to answer questions, as many as I can, before we start the second half. If there's too many of them, I'll save them till the end. And again, if we don't have time during that time, then I'll make sure that we'll get all of your questions that have been entered. We'll make sure that they'll be answered in a written format. So based on that, let's talk about some of the changes that came about. Now, this was not part of the ATRA Act, the new act. These changes actually happened usually at the end of October. The IRS comes out with cost of living adjustments to IRAs. For the first time in 5 years, we actually have an increase in contribution limits to IRAs, effective for 2013 contributions. So the 2012 contribution limits to traditional and Roth, and when I say these are contribution limits, these are not just deduction limits. These are contribution limits on how much you at the bank should take in as regular contributions to traditional and Roth. So for 2012 contributions, if they're under age 50, the most they can put in as an annual contribution is 100% of their earned income, up to $5,000. If they're 50 or over, it goes up to $6,000 because they get a $1,000 catch-up. Don't take more than this. These are the maximum contribution limits. Now, if they're making a 2013 contribution, they get a $500 increase. So $5,500 if they're under age 50, and 50 or over $6,500. Now, here's the tricky part. I hate when contribution limits go up because all you have these customers who think they're smarter than the IRS and that they're going to beat the system. And a lot of them say, well, I'm not going to make my 2012 contribution in 2012. I'll wait till 2013 to make my 2012 contribution because then I can put $500 more in. No, you can't. Any contributions that the bank takes in between January 1st and April 15th as a prior year contribution for 2012 still has the 2012 limits of $5,000 or $6,000. If they are making a current year contribution for 2013, then they can add the extra $500 to it. So don't let them tell you I want to put in more for last year. Say, no, our system won't take it. Our system will not take that extra $500 for last year because the edits built in for 2012 contributions are locked in at $5,000 and $6,000. Okay? The other thing I want to point out is traditional and Roth, and I did point this out in the basic also, traditional and Roth plans are the only IRAs that are linked together for contribution maximums. And what I mean by that is any amount you put in the traditional will decrease your Roth contribution amount for the same year. So when you add your traditional and your Roth contributions together, they cannot